Hello and welcome to this series on systematic trading. Our guest for this series is Aamodh. In part 2, we explored how different market regimes impact range breakout strategies, specifically intraday range breakouts. In part 3, we shift our focus to understand how market regimes influence time-based straddles. If you're new to this concept, I would strongly recommend watching episode titled 7 Years of 920 Straddle. That will give you a solid foundation of what these time-based straddle strategies are and how they behave. So, Aamodh, we were talking about market regimes and we went through this example of range breakout.
Yeah.
Are there any other strategies where you have seen the effect of market regimes, and do you want to talk about that?
We saw the example of range breakouts in long options. The conclusion there was that over time, markets have tended to be less trending, both in terms of frequency and magnitude.
Correct.
Right? No matter whether you trade it with long option or short option, you expect to see the same observation because that's the
behavior of the underlying.
Correct. We can take an example of time-based straddle strategy.
Okay.
And see if something similar we observe with the short option strategy as well.
Fair enough. Let's do that.
So first thing, briefly about what exactly is a time-based straddle and what exactly is it not.
Sure.
Time-based straddle is where you sell a short option at the money straddle, short straddle, at a particular time instant of the day, place some percentage of stop loss on the individual call and put legs. You exit it at the end of the day, intraday, if the stop loss is not hit. You repeat the same thing day in, day out.
So since you're talking about time-based straddles, one basic question. A lot of people, there's generally a conversation that time-based straddles don't work, and then there is a gang which says, no, it continues to work. Yeah. So which side of the gang do you belong to?
I belong to both gangs, to be honest. I trade time-based straddles that work. But if someone's saying time-based straddle doesn't work, I kind of can relate to that as well. Simply because time-based straddle is just a structure.
Okay.
Right? Using this structure, you can implement quite a few functions.
Yeah.
Right? So whether time-based straddle is working or not working depends on what kind of functionality you're trying to implement using the structure of time-based straddles.
Got it.
Time-based straddles has quite a few variables in it, right? Things like how much percentage stop loss do you place?
Entry time, exit time.
Entry time, exit time, and your strike selection logic itself. You could sell a straddle or you could sell a strangle. So when I say time-based straddle here, conceptually, I mean to say time-based strangle as well. It's basically short option, both call and put leg selling. So depending on what your stop loss percentage is, you could try to implement a trend following functionality or a mean reversion kind of functionality.
Okay.
Using time-based straddles, you can try to benefit out of both trending days, directional days, as well as non-directional days.
Depending on how you structure the trade.
Depending on how we structure the variables present in the structure.
In the framework.
Yes, in the framework. So we talked about earlier where we talked about idea generation. I gave example of time-based straddle. One trader can enter a time-based straddle with 25% stop loss. Another can enter it with the time-based straddle with 200% stop loss. So if you look there, the person who is selling a time-based straddle with 200% stop loss is essentially betting on market not moving beyond a range which is going to hit his 200% stop loss.
Correct.
He is playing for market staying within a range. Essentially, we can term it as anti-range breakout. He's betting on range not breaking out.
Range as defined by the structure stop loss levels.
Range as defined by the stop loss levels that you have placed. The stop loss levels may be the same, but then there's a nuance here, right? Options trading has two factors which can influence your profit. One is the movement in the underlying. The other one is the days to expiry, things like the Greeks, the time decay, volatility component, all those things. Now, you might put a 200% stop loss on all days, but the range in the underlying that hits the 200% stop loss need not be the same both days. Certain nuances exist. So it is a anti-range breakout, and the range is very much dependent on what DT it is, what premiums are on offer, what's the expected volatility, things like that. And now the other side of things, time-based straddle with the relatively tight stop loss, like a 25% stop loss, it's essentially a range breakout strategy. You are betting on range breaking out of that whatever stop loss percentage that you have placed.
And it persisting in that direction.
Correct. And the trend continuing.
Yeah.
Added benefit with the tight stop loss time-based straddle is that if neither stop loss gets hit, then you benefit out of premium decay, which is, it does not happen often. So there's this concept of structure versus function. A time-based straddle is just a structure. Whether a strategy is working or not depends on what functionality is being implemented using this time-based straddle structure.
Okay, give me an example.
So for example, I mean, with this previous market regime example, we have seen that markets have tended to be less trending over the years.
Okay.
Right? So we can, backtest using a time-based straddle, the same concept, whether it holds true, and check.
Okay.
Right? So we'll do that. So let's take three strategies, time-based straddle strategies. You are selling at the money straddle at 9:30 a.m.
Okay.
And placing a stop loss of 25% in strategy 1, a stop loss of 100% in strategy 2, and a stop loss of 300% in strategy 3.
Okay.
So we'll backtest this and see whether we can relate to whatever we observed with the long option range breakout.
Sure.
When I said 300% is stop loss, majority of traders who probably understand risk and reward would think this is a very low risk reward trade, right? With option selling, the maximum reward that you have on offer is the premium that you are selling.
Yep.
You sell the premium, it goes to zero. That's the maximum reward that you have, which means that if you're putting a stop loss anything beyond 100%, theoretically, it's a reward to risk ratio of less than 1.
Correct.
So when you place a 300% stop loss, it essentially means your reward to risk ratio is 1 divided by 3, 100 divided by 300, which is 0.3, which is very low, right? Most people tend to avoid this wide
strategy.
stop loss strategies. I have a different way of looking at this. Just like implied volatility and realized volatility, I consider something as implied reward to risk and realized reward to risk. What do I mean? So in this 300% stop loss, for example, the implied reward to risk is 1:3, whereas realized reward to risk is basically the ratio of average winner to average loser in the backtest report.
So expectancy in a way.
No, it's not the expectancy, because expectancy factors in win rate as well. This is just the average reward to risk.
Okay.
The ratio of average winner divided by average loser.
Oh, instead of single conceptual theoretical take, you're taking real
Correct.
outcome.
So the caveat here is that your backtest results are path dependent, right? It could have played out differently for the sequence of outcomes that played out. That is what you have got.
Absolutely.
Right? And there is no guarantee that the same path will be taken in future. So when you're looking at average ratio of average winner to average loser, that's the risk that you're carrying. Now I'll show you some data. We will take this time-based straddle 9:30 time-based straddle example. On the x-axis of the graph, we will sweep through different percentages of stop loss.
Got it.
On the y-axis, we are going to plot the ratio of average winner to average loser.
Sure.
Right? So we'll see how the graph looks like.
Sure.
This is the graph that I was talking about. On x-axis, you have different stop loss percentages, and on y-axis, it is the ratio of average winner to average loser. So as you can see, the red color line, it's the implied reward to risk, or the ratio of your 100% of premium is the maximum reward and the percentage stop loss that you put. If it's a 300% stop loss, then 0.33 is your implied reward to risk.
Got it.
Which you see at the end of the graph over there, right?
Correct.
And the blue color line is the realized reward to risk. You would kind of imagine that the realized reward to risk probably decays down, just like implied reward to risk. But what you observe is something different. So this backtest is done over like 7+ years of Nifty weekly option data. So it's large enough sample size, right? So you see that initially the implied, the realized reward to risk drops down until
Hmm.
something like a 50% stop loss or 75% stop loss.
Got it.
But beyond 75% stop loss, unlike implied reward to risk, realized reward to risk actually increases
Increases.
to a certain point before it tapers off. And even when it tapers off, the realized reward to risk is much higher than the implied reward to risk.
Got it.
So, which brings me to the question, would you not trade this strategy just because implied reward to risk is low? My personal opinion is that I would not do that, because for me what matters is realized reward to risk, because implied reward to risk stays on the calculator,
Hmm.
and realized reward to risk is what ultimately shows up in your bank account. I would treat a 300% stop loss as good as a 25 or 50% or any other stop loss for that matter. I wouldn't be biased against a wide stop loss just because the theoretical reward to risk is low.
Got
That's
it.
the point,
Got it.
right? So now let's get back to evaluating market regimes using time-based straddle example.
Sure.
So now let's look at the backtest data over 7 years of
Okay.
Nifty weekly options for these 3 time-based straddle strategies.
Okay.
You have, as you can see in the table, 25% stop loss, 100% stop loss, and 300% stop loss.
Got it.
What you observe is that expectancy wise, 25% stop loss has had the highest expectancy.
Mm-hmm.
Overall profitability wise, you have 25% and 100% stop loss almost close to each other.
Mm-hmm.
Right? Calmer, or the return to max drawdown ratio in 25% stop loss is way higher than
Correct.
100% stop loss.
Hmm.
So one might be inclined to trade 25% stop loss instead of the rest,
Hmm.
because that has the best expectancy, calmer,
Yep,
and
yep.
things, right? So let's look at the backtest data of these 3 strategies: 25% stop loss, 100% stop loss, and 300% stop loss. One thing to note here is that this backtest is only for 0DT,
Mm-hmm.
which means that only one trade per week will be taken on the 0DT day of
Got
the
it.
week.
Got it.
Now, one would observe that the expectancy of 25%
Mhm.
stop loss is the highest, and so is the return to max drawdown ratio. It is much higher than the other 2. And so, just looking at this data, one might be biased towards trading 25% stop loss, just like we did with the long option range breakout. Let's do a in sample out sample kind of analysis, splitting down the date ranges to different regimes and compare how these 3 strategies have performed over the years.
Okay. The regimes are similar to what we defined earlier for
Yes,
range breakout.
yes,
Okay.
the regimes are similar, because irrespective of what the strategy is, the regime is regime. Right?
Fair enough. Fair
Yeah.
enough.
So this is what we observe, right? We have the graph of both these 3 strategies
Mhm.
as far as average annual returns is concerned. Disclaimer as usual, this is just a historical return. This is not a guarantee of future returns. So don't jump into trade this strategy with the assumption of that.
Absolutely.
You would see that going by the trends, downtrend is observed in the 25% time-based straddle strategy. This kind of correlates with our observation with long option range breakout, where the tighter stop loss strategies have tended to underperform over the years. You look at 100% stop loss strategy, the annual return, average annual return has gone on increasing over the regimes.
Hmm.
And you look at a 300% strategy, which someone would ignore just because the theoretical reward to risk is low, has performed the best out of the 3. And it has performed relatively better than its earlier past, higher than any of the other 2, right? So if you want to go by form, right, 300% stop loss is what you probably would want to look at. But if you want to look at consistency, you probably would be inclined towards 100% stop loss, because it has done well over the years. You never know if the regime where the 300% stop loss did not do well comes back in the future. You never know that. So which one would you choose? 25% stop loss profitability has gone down over the years, but overall over the 7 years it has given the highest profit. Would you choose that? Or would you choose 100% stop loss, which has consistently done well over the years? Or would you choose a 300% stop loss? which is the informed strategy out there. So that's the question one would have to answer, which is ultimately a discretionary call in a systematic trader's game. The key thing that differentiates discretionary traders and systematic traders is that, of course, many things, but one of the important things is that as a discretionary trader, you make discretionary decisions during market hours.
Correct.
As a systematic trader, whatever discretionary decisions that you have to take, it's outside of market hours.
But it does not mean that the systematic trader is not taking a discretionary decision, but it just does not happen during the trade.
Yes.
Or during market hours.
Yes, that's right.
So looking at the data, I'm curious, why would 300% underperform, let's say, in a regime where 25 and 50 are performing?
Yeah, so this is because in the earlier years, like let's say 2019, 2021, we used to get like 6-7 trending days in a month, right? Trends used to last longer during the intraday, as well as trends used to happen more frequently. So when a long lasting trend happens intraday and you place a 300% stop loss, one leg of the stop loss gets hit
and the other doesn't compensate for the losing leg.
Yes. So you're selling a 100 premium call and put and you're placing stop loss at 400. If stop loss gets hit one side because of a trending move, then you lose 300 points on that leg. The other side, even though it decays to 0, you make up only 100 points. So overall, when you get more trending days more frequently, 300% strategy underperforms.
Got it.
Let's revisit the earlier question that was asked. Has time-based straddle stopped working? These 3 graphs that are in front of you would answer it by itself.
Yeah.
So if you're a trader who has traded tight stop losses, then probably time-based straddles isn't working as well as early times. If you're someone who has put relatively wide stop loss, I think time-based straddles is still working, right? So that answers the question.
Okay, so there is no one answer to it. It depends on what kind of parameters that you use.
Yes, right. The important thing here is that one needs to trade a strategy which is in sync with the market regime. The earlier market regimes had more trending times. The current market regimes have more choppy sideways regime, right? So if you need to have your strategy in sync with the market,
which makes sense to me. But then one of the problems which I face typically is how do market regimes are changing. Everyone, we all are aware of it, and it changes. And once it changes, there could be a persistence to it. There may not be a persistence to it. So, for example, on what basis do I decide that, hey, you know what, I think the market regime is changing now, and hence I should shift or change the structure of my trade? So, I don't know, I don't expect an answer, holy grail kind of, this is a holy grail kind of a question. But how do you think about this problem?
It's a very difficult question to answer straight away, because there is no way one can predict beforehand, and by the time one realizes that market regime has changed, if he is late, a new market regime may have already kicked in.
That's possible,
right? So multiple things can happen. The way I look to solve this problem in my trading is by trading multiple strategies with different functionalities. Earlier there were trending times, now there are less trending times and more choppy times. My approach would be to trade a basket of strategies in my portfolio, some catering to trending market moves, some catering to non-directional market moves. Over a particular phase, one might be lossy and another might be profitable, but over a large enough sample size, it evens out and it adds value not just in terms of overall profitability, but also higher return to max drawdown ratio.
Got it. Makes sense. So in essence, you're saying diversify in such a way that you're trying to capture different kinds of market structures, and hope that in the long run they all add up and you get a clean equity curve.
Yes, that's right.
Got it. So that brings us to the end of this episode, where we explored the impact of market regimes on time-based straddles. In the next episode, we'll take this a step further. We'll break down different types of risks and look at two fundamental approaches to position sizing. Thank you for watching, and if you found this episode useful, do let us know in the comments. And if you have any questions, feel free to drop them. We will try our best to answer them. See you in the next one.